This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Justin's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a drawdown of 5.1 million barrels of crude oil, Cushing, Oklahoma building 50,000 barrels, but there were big builds on the finished products, with gasoline building 2.4 million barrels, distillates building 3.4 million barrels, for a net petroleum build of 0.7 million barrels, despite the drawdown on crude oil. U.S. production holding steady at 13.5 million barrels. The story is pretty much the same as the last couple of weeks. There's plenty of room for more weakness in energy prices on macro fundamentals, but there's also plenty of room for a dramatic spike higher if the geopolitical situation escalates further. I'm flat here, and I really don't follow the crude oil market as closely as I used to, so I don't really have a strong view.
Well, Eric, when we look on page 2 at the crude oil futures, you clearly can see that the price action remains in the favor of the bears. Now, there is a major support line. The lows have established. There's a fair value zone in this $68 to $71 area that continues to have a 3-month consolidation in there. But every time crude oil rallies, it's making a lower high, which means someone keeps leaning into selling on every pop. And now, while the support line is holding, this is winding up in one big wedge formation. The bigger question is, which way is the next break? At this moment, it remains below all those key moving averages, lower highs, distributive price action. There is entirely possible that technically we break that support line and head down to low 60s. Now, I think that that may be an overshoot, and then it snaps right back and may even be a short-term buying opportunity. But it's really hard technically to make a bull case. It would take a substantial amount of price action up in the mid-70s to start technically repairing this chart to actually establish some sort of a trend change. But right now, there's no sign of that. Now, Eric, let's talk about the equity markets. What are your thoughts?
Well, Wednesday marked yet another all-time high on the S&P, but let's not forget, booms are generally followed by busts. And I have no idea how long this particular boom can last before it busts, but I think it will eventually.
Yeah, Eric, absolutely that the markets continue to make all-time highs. The pattern of accumulation is so evident. Higher highs, higher lows. Even on a day-in, day-out basis, we don't go and break previous day lows. Money keeps flowing into this market. Well, I've measured moves up to the 61 to 6,200. So there's definitely room for even 100 more S&P points in this particular impulse higher. But we do have the jobs numbers coming up. And if there was some kind of a news event that could potentially at least cause some sort of corrective pattern to ensue, it would be some sort of event risk and as like a surprise number. Now, I'm not saying that that's what I'm anticipating, but watching these kind of key events is going to be the important turn points. It could be an inflation number. It could be the FOMC. At some point, something is going to spur a mean reversion off this. But right now, the path of least resistance is completely in the favor of the bulls as they remain completely in control of this price action, with a little bit further on the upside. At some stage, we will get a pretty deep market correction. But with the way things are shaping up this year, it may very well be a January story, and it could end up being a very quiet Christmas period if this trend continues. Now, Eric, let's talk about the dollar.
The Dixie has finally begun to consolidate, but there's no clear sign of a trend reversal, at least not yet. So I'm waiting to see what happens.
Well, Eric, we did have that print up towards 108, and then we've seen some sort of corrective pattern getting underway. And we talked about it in last week's Talking Charts. There's room for the U.S. dollar to continue to mean revert a little bit from just such an extremely strong impulse since putting in its lows in late September. The consolidation could go down to even the 105 level on the Dixie as the euro can work its way back to even 107 on the upside. But there's a primary bull trend that's been established. And at this juncture, there's not a lot of reason to believe that this bull trend is over. We were just due for a correction, and we're seeing price action that resembles a correction. I think that this presents still a buying opportunity. In my mind, the euro is doing some significant technical damage, and it's such a huge weighting in this dollar index that if the euro heads to parity or even lower, back to 2022 lows at 95 cents, that the dollar index can easily find itself at 112 or higher in that kind of an environment. Will that all materialize? Odds of it materializing in this calendar year with 3-4 weeks left in the year, it's more likely the dollar's going to finish the year in this consolidation. But it'll be certainly an interesting story going into January, February, whether or not the dollar index has one strong bullish impulse left in it. So moving on though, Eric, let's touch on gold.
There's a short-term symmetrical triangle on the chart that really, should be at the end of the road here. It should resolve up or down. It hasn't yet. We closed Wednesday pretty much right at the point on the triangle there. So we should see some directional indications soon, and hopefully that will be the tell on where the next leg takes us from here.
Well, Eric, while I agree that there is a triangle formation developing, I still will not rule out that it zigzags its way for one more quick washout down towards 2,500, irrespective of whether there's one more corrective cycle down or not. I remain very bullish gold and view this consolidation as an important buying area. So if we did get a dip of $100 or more on the downside of gold, I think it would be a compelling buying opportunity that will probably be very short-lived if one was to have an opportunity there. At some point, we're going to get a breakout. But if we don't get it by the FOMC meeting, then odds are that this is going to push out into a January story. Moving on, I wanted to touch on that uranium chart. I know Justin and yourself had an extensive conversation on this, but this is the chart of the Sprott Uranium Physical Trust on page 6. And what we continue to see is that this is creating a basing formation for what was basically one big 2024 correction. Now, the big question, of course, like you were discussing with Justin, is when do spot prices start to react? Because that's the moment when something like this spot physical trust are going to start seeing that bullish breakout. It's going to need spot prices to rise for it to be trading higher. The big question here is that does it happen now or at these levels? At this stage, we do need a legitimate breakout above $27 on this chart, with U308 breaking legitimately back up into the 80s in order to get this going. Obviously, with only a few weeks left in the year, it may still just grind it out along this 50-day moving average a little bit longer, but it is setting up for what will be probably a pretty compelling bullish breakout in the new year. Finally, I wanted to just touch on some bond charts. Now, normally we look at yields. I'm specifically looking at bonds and whether or not they're bullishly breaking out. So on page 7, I have the 2-year T-note futures. Clearly, there was a very dovish stance in the market going into September, into the first rate cut. Since then, we've seen the 2-year note have a pretty distinct retracement and correction. Now, the big question, of course, is has this now gone a little too far? Is the Fed policy going to shift? Going into the FOMC, it'll be very interesting to see whether or not a short-term low has been put in here in November and whether a new bull trend starts to establish itself on anticipation of the Fed path. And on page 8, we have the long bond, the Treasury bond futures. And on the long end, we had obviously inflation fears and other things cause a mean reversion all the way back to the summer lows on the long bond. Since then, from a very oversold condition, we've had a reflexive rally. The sentiment was just so negative toward bonds. And so now that we've snapped back, got back above the 50-day moving average, it is very hard to make a case yet that this is a new bull trend, just because when something is so oversold, the most common thing is for it to bounce and react, and we got that. But what will be very interesting at this stage is whether or not that November low ends up being the bottom of this bond range. And if we start seeing anything that brings back recession risks or fears as economic slowing numbers might eventually materialize, maybe there's room for Treasury bonds to actually have a rally back up to the top end of these ranges. It's not a big macro call, but rather simply looking at whether or not bonds have once again simply overshot on the downside and will mean revert back to a more realistic range considering where most asset prices are currently trading.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.